That steady income from dividends, for many, it's not just a bonus, it's essential, a reliable check that helps pay the bills or fund retirement. But what happens when that income suddenly shrinks or disappears entirely? Because dividends aren't guaranteed. They can be cut, sometimes abruptly, leaving investors in a tough spot. The key question is, can you see it coming? While you can't predict every cut, the good news is that the warning signs are often there, flashing red for anyone who knows where to look. Let's start with the most common dividend trap, the siren song of a super high yield. You see a stock with a yield of 8, 10, even 12% and think it's a bargain. But unusually high yields are rarely a sign of corporate generosity. They are almost always the result of a collapsing share price. Think about it. Yield is the annual dividend divided by the share price. If the price plummets, the yield skyrockets mathematically. This is the market's way of screaming that it doesn't believe that dividend is sustainable. A double-digit yield is a sign that a cut is already being priced in. High yield is not a strategy. Sustainability is. That falling share price is your second major clue. It's often said markets are irrational, but over the long term, stock prices follow a company's power to earn money. A prolonged, steady price decline is a form of market consensus. It's the collective wisdom of thousands of investors, signaling that there are deep, underlying problems with the business. A stable or rising price, on the other hand, suggests the market sees no major stress on the horizon. It's not a guarantee, but it lowers the probability of a cut dramatically. Next, look at the company's resume, its dividend track record. Trends persist. A company that has consistently raised its dividend for years, even decades, has proven it operates a profitable, resilient business model. It's delivered through economic booms and busts. This history doesn't predict the future, but it sets a baseline for risk. Conversely, a company with a weak or inconsistent record of paying shareholders needs a very strong argument for why things are suddenly going to get better. Then there's a simple rule of finance. A company should not distribute more money than it earns. This is measured by the payout ratio. If a company pays out more in dividends than it makes in profit for 1 year, that might be okay. But if it becomes a pattern, risk rises sharply. It means the dividend is being financed with debt or by selling off assets, a practice that is fundamentally unsustainable and typically ends with one outcome, a dividend reduction. Weakening earnings momentum is another sign. Dividends can only grow over the long term if profits do the same.
So, while there are many ways to analyze dividend safety, deep dives into cash flow, balance sheets, and forecasts, you can get a powerful first read by focusing on 3 signals. They are immediately visible, hard to dress up, and often capture reality faster than quarterly accounting. 1. The dividend track record. Does it show resilience? 2. The stock price behavior. Does the market see trouble? And 3. The dividend yield. Is it suspiciously high? If these 3 signals look healthy, the dividend is most likely on solid ground. If they don't, that's when you need to dig deeper. Ultimately, no analysis is foolproof. A surprise economic downturn, a regulatory change, a strategic shift, any of these can trigger a cut. That's why your ultimate safety net isn't finding the one perfect stock. It's diversification. A well-diversified portfolio ensures that if one of your companies is forced to cut its dividend, the impact on your overall income is manageable. The goal isn't to avoid all risk. It's to prevent any single event from becoming a financial disaster.